All right. So my name is Christopher Vasilakis, and I did straight down stocks. So as many of you know, I shorted the market, and therefore my presentation may be a little dissimilar to the ones you've already seen so far. I named it straight down stocks in anticipation of a market-wide capitulatory sell-off, or in layman's terms, straight down. So what stocks did I choose to purchase? So I actually did not buy any single name stocks, like Apple or Amazon, for example. I went strictly with ETFs. So I initially purchased SQQQ, SPXS, SPXU, PSQ, and SH. And I later made I actually technically made 8 trades, but I later traded for QID, SOXS, and SPY. Okay, so why did I short the market? Well, for 3 main reasons. First, high inflation. Second, Federal Reserve hawkishness. And third, the inverted yield curve. Okay, so first off, high inflation. So recently, we've been in a period of extremely high inflation. Inflation levels that haven't been reached since 1982. In June, we got an inflation print of 9.1%, and from 2020 to 2021, our M2 money supply, which is essentially a tracker of all liquid assets plus cash, increased from about $15 trillion to $22 trillion, which is 40% increase. The Federal Reserve aims to keep inflation at 2%. And like I stated previously, with the 9.1% inflation print in June of this year and continued high inflation prints, they need to inject/remove. So in this case, they would have to remove money from the market to bring down this inflation, and they do that through quantitative tightening. So Federal Reserve hawkishness. The Federal Reserve is raising interest rates to fight inflation, and they do this at the expense of the economy. So currently, we're at a 4.0% interest rate, and they have been very aggressively hiking interest rates this year. We're in a stage of quantitative tightening, which means that the Federal Reserve has to basically sell off their assets on the open market, and they also increase the interest rates. Which is the opposite of quantitative easing, which is what we were previously in during COVID with all the relief checks and stuff and cheap interest. They ended up lowering interest rates. They gave money to banks. Banks gave money to people. It stimulated the economy. And recently, the chairman of the Federal Reserve, Jerome Powell, said that we still have some ways to go in terms of interest rate policy over the next few months, and this negatively affects markets because, well, higher interest rates means less money to go around, and yeah. So my third main reason for shorting the markets as a whole was the inverted yield curve. So the inverted yield curve refers to the inversion of yield and maturity. It means that short-term US bonds are paying higher interest rate than longer-term US bonds. Under a healthy macroeconomic environment, this curve wouldn't be inverted. The longer-term treasuries would be paying more than the shorter-term treasuries, and the shorter-term treasuries would be lower. So as you can see from the graph here, every time this blue line crosses the black line at 0%, crosses underneath it, it means that the 10-year versus the 3-month treasuries are inverted. And as you can see, the gray sections are all recessions, and each time this has happened, it has preceded a recession, and it just happened a couple months ago, whatever. This signifies that smart money is being more cautious with their money. They are no longer putting their money into shorter-term, riskier bonds, and they're moving it to longer-term, safer bonds. This is a sign that the market is becoming pessimistic about the economy in the near future. All right, so for my stocks, what is SPY? So SPY is a publicly traded exchange-traded fund that tracks the leading top 500 publicly traded companies in the USA. So SPY's top 8 holdings consist of Apple, Microsoft, Amazon, Tesla, Alphabet, Berkshire Hathaway, United Health, and Exxon. So it's a collection of a lot of the stocks you guys have purchased, and those make up about 23.5% of SPY. And a little fun fact, despite it actually tracking 500 companies, it has 506 holdings because of companies like Alphabet. There's like Alphabet Incorporated Class A, Alphabet Incorporated Class C, which are technically the same company, but they're under two different stocks. All right, my stock's relation to SPY. So SPXS, SPXU, and SH are all inverse shorts of the exchange traded fund SPY. They are -3x, -3x, and -1x respectively. So for example, if SPY goes down 1%, SPXS will climb 3%, SPXU will climb also 3%, and SH will climb 1%. Okay, so this is a chart of the performance. It's not necessarily a traditional chart that you would see with like the asset being at $30 or whatever. It is a relative price chart, so you can see the percent changes based from the initial starting period, which was around when school started. The top two are SPXS and SPXU, which are both, once again, the 3x shorts. They're essentially the same stock, but they are both graphed there. That's why it kind of looks like one line. Underneath it in the middle, we have SH, which is the 1x short of SPY. And then at the bottom, we have your traditional SPY, which is just tracks the top 500 companies, US companies. So we started the competition, and then shortly after we ran up and we printed a poor CPI print, which is essentially inflation, which was 8.2% year over year, and it was estimated to be 8.1%. The markets reacted somewhat negatively, which shot the SPXS position up, but they didn't react as negatively as I would have expected, which I'll get into why that's important shortly. Right after the event, we kind of bled down into November and then came in the FOMC meeting, which is essentially where the Federal Reserve says, okay, this is how much we're going to be raising our interest rates. They announced a 75 bips increase, which essentially means each bip is a basis point. Each basis point is 0.1%. So they essentially rose interest rates by 0.75%. And once again, the market reacted negatively to this, but not as negatively as I would have expected and hoped. And therefore, a few days later, I ended up selling off my 3x shorts, both of them, in exchange for a 1x long, which is just your traditional SPY, and a tech short, which I'll get into later, because it was weird that the market wasn't reacting as negatively as it should have, quote unquote, and I felt something was off in the market, so I decided to hedge myself against any potential downside. And then, as you know, or what happened after was we had another CPI inflation print. It was very good. The market reacted very positively. It climbed pretty substantially, and then what would have been my holdings plummeted. As you can see, they just plummeted right down. And then shortly after that, I re-entered in my positions. I went risk on again in terms of shorts. I sold my 1x short. I sold my 1x long, which were essentially a delta neutral pair, a replacement for cash. And I purchased SOXS, and or SPXS and SOXX, which I'll describe what that is later. All right, so for my results. Okay, so for SPXS, I opened a position, I closed it, and I opened another one. So there are technically two trades on here. I initially opened it at about $25. I opened 794 shares, and I closed them at about $25. And then I opened up another position at about $20 for 990 shares, and then sold it about $19 for a total loss of about $1,000. My next stock was SPXU, which is the other 3x short. I opened it at about $19 for 1,045 positions, and then sold it for just a little lower, around $19 as well, and lost $300 on it. And then my last of the SPY shorts was SH. I purchased 1,220 shares at about $16.39. I sold them at $15.33 for a loss of about $1,400. And then my SPY trade, which was only open for about 2 weeks, I opened that at about $374. I opened 53 positions and sold them at $400 for a gain of $1,200. All right, so what is QQQ? So QQQ is an exchange traded fund that tracks the NASDAQ 100 index. So the NASDAQ 100 is essentially a basket of tech stocks, primarily tech stocks. Its top 5 holdings consist of Apple, Microsoft, Amazon, Alphabet, and Alphabet. Kind of like I described before, QQ actually has 102 holdings, despite it tracking the NASDAQ 100, because there are companies, like I mentioned before, like Alphabet, who have 2 stocks for essentially one company. And those 5 companies make up 35% of QQQ. So what are my stocks' relation to QQQ? Well, SQQQ, QID, and PSQ are all negative 3x, negative 2x, and negative 1x shorts of the QQQ. So for example, if QQQ goes down 1%, SQQ position will go up 3%, my QID position will go up 3%, and my PSQ position will also go, my QID position will go up 2%, and my PSQ position will go up 1%. So why did I short tech? Well, the technology sector is typically valued on the prospect of strong future profits. Most tech stocks have betas above 1, meaning that they are more volatile than the market as a whole. Tech stocks are also extremely receptive to interest rates and have historically performed poorly in times of Fed hawkishness. In a recessionary environment, tech stocks have historically taken the largest and the quickest hits in terms of their share prices. This is because most tech companies produce goods which are elastic and also generally have higher valuations or PE ratios. The average PE ratio for the NASDAQ 100 or QQQ is about 27.64, whereas the S&P 500 PE ratio is much lower at about 20.5. And because we have been in, and I believe will continue to be in, a period of strong economic downturn, a risk-off environment, I believe that shorting these companies that are extremely, not overvalued, but highly valued, aka tech stocks, would be the play. So here we go. It's the same chart as before. It's a relative price chart with the price starting at the same date as my SPY chart. The top stock is SQQQ, which is the 3x short. The middle is QID, which is the 2x short. And the bottom is PSQ, which is the 1x short. They're color coded as well. So we started the competition on October 6th. Very similar price action to the SPY graph. So as you can see, after CPI, we kind of whipsawed a little and then bled down. But the one big difference is around the week of like the October 25th, 26th area, there were really bad tech earnings, which is why many of you may have seen your Amazon positions, your Facebook positions, whatever, have been hit pretty hard. So on October 25th, Microsoft limited down 8% overnight and continued to drop 15% over the next 10 days. Then the next day, on October 26th, Meta limited down 24%, and then it dropped 32% over the next 10 days. And then finally, the next day, on October 27th, Amazon also limited down 12%, and then dropped 28% more over the next 2 weeks, which caused, as you can see right immediately around that area, we had a spike up in my tech shorts, which means that the underlying assets, so Amazon, Facebook, whatever, all went down. And then we had the same type of price action. We had Federal Reserve. The market did not like that. It reacted poorly, meaning my positions went up. And then around the trade on November 4th, I purchased QID, which was the same philosophy as before. Essentially, I wasn't seeing the reaction out of the markets as I would have hoped, expected. So I purchased QID as a lower leverage short. It was a 2x short opposed to a 3x short, and I also believe that tech would underperform S&P 500, so I just chose to basically swap it out, swap out the 3x short for S&P for a 2x short for tech. And then we kind of just, after the poor CPI print, we kind of just bled out until the end of the competition. So my results on the tech shorts. So I purchased 384 shares of SQQQ at about $52 and sold them at about $42 for a loss of about $4,000. I also purchased 698 shares of QID at about $28 and sold them about $22 for a loss of about $4,200. Lastly, I purchased 1,420 shares of PSQ for a price of $14.09, sold them at $13.47, and realized a loss of $880. Okay, so my last industry that I shorted were semiconductors. So what is SOX? What is semiconductors? So SOX is an ETF that tracks the top 30 US listed semiconductor companies. Semiconductors are essentially computer chips. And SOX was founded in 2010 by Direction, and its top 5 holdings consist of Texas Instruments, Broadcom, NVIDIA, Qualcomm, and AMD, which make up about 35% of its allocation. So why did I purchase SOX? Well, SOX dropped 65% in the 33 days prior to my trade off the back of face-stripping rallies across many semiconductor stocks. These semiconductor stocks are heavily mispriced with extreme downside risk in a rapidly deteriorating risk-off macroeconomic environment. SOX is also simply a larger beta than tech. And since I expect tech to drop significantly, it only makes sense that I expect stocks would follow lead and underperform to the downside. And lastly, as a cyclical industry, semiconductors perform very poorly in periods, such as those of economic downturn. So here's my chart of stocks. This is a traditional chart. You will see on the right side, we were at about $33 at the time that I took the screenshot. We could see the initial drop off from about $72 down to a low of about 28 or so, and I purchased around that low. There was no news in between my purchase and my sell, but we did set a high of about $36 and a low of about 28, but in the end, I ended up selling my position at essentially the same price I purchased it at. So my short result for semiconductors. My open price for SOX was $31.46. Then I later sold my 635 shares at $31.79, and I made a profit of $110. So we have a timeline of my trades. So on October 6th, with the start of the competition, I initially purchased 1,420 shares of PSQ, 1,220 shares of SH, 794 shares of SPXS, 1,045 shares of SPXU, and 384 shares of SQQQ. On November 4th, my first trade, I sold my SPXS and SPXU positions for losses of $362 and $298 respectively. With those proceeds, I purchased 53 positions of SPY and 698 positions of QID as a pseudo hedge, as I explained before. And then about 11 days later, I made my second trade where I sold off my SH position and I sold off my SPY position, which were essentially a delta neutral combo. And I ended up purchasing 635 shares of SOX and 900 shares of SPXS. Then on the last day of the competition, I liquidated all my assets and I ended up selling my 1420 PSQ positions for $880 loss, my 698 QID shares for a $4,200 loss, my 635 SOXS shares for a $110 gain, my 990 SPXS shares for a $1,000 loss, and my 384 SQQ shares for a $4,000 loss. So here's my tracking graph. Started off at 100,000 obviously, and then week 2 I peaked. So this is where many of you probably saw the lows of your accounts. This is where I saw the high of my account. This was the inflation print, the initial inflation print. And it was, like I said, it was a poor print, so your accounts went down, the market as a whole went down, so my stocks went up. Then we kind of bled off. This little lower high here on week 5, I was a couple percent above break even. I think at peak I was like 9% in the green, but ultimately it just was in the end a lower high, and we continued bleeding off until week 9 when I finished just about 90,000 at $89,000. So in the end, the only thing that went straight down was my portfolio. Thank you.